Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Glad to be back and thankful to him and Zach doing a great job last week. Never an easy one when you've got things going on in the world like we did with Israel, and we're quite aware that will be with us for some time. Of course, we hope not, but will be with us around each and every corner here trying to see which way the world goes. So far, markets have held up great. But we're always on the lookout for the ways to best hedge our portfolios and best be positioned. We want to hit three topics we discussed in depth at this week's investment meeting. We're going to talk about the Fed's next move, which is coming upon us rather quickly. Andrew's going to then talk about small caps and the positive sign we're seeing there, as well as U.S. oil production. So let's go into the Fed's next move. So coming into this meeting in November, just one of two meetings left in the year, it is possible that they will raise interest rates, but right now, according to financial betting markets, it's more possible that they don't give us another interest rate increase. And as I shared with those of you that came to the third layer listen, I think the bigger part or the bigger thing to look for, rather than the interest rate increase, which of course would be huge whether we get it or not, is whether or not they lay the groundwork for cuts next year. As of right now, according to the Fed's last predictions and the market's predictions, both call for 2 rate cuts next year. And I think it's quite possible we see those come off the table. And here's a big reason why. The data that we've been getting in continues to be showing one that the economy is resilient. In this case, what we're looking at is not only resilient, but it's coming with some inflationary pressures. This is showing you each month's preferred measure by the Fed's inflation reading. And what we've seen over the past few months after seeing inflation come down is starting to swell back up again, and now back to the average we've seen here over the past several years and trending in the wrong direction. So if that happens, that kind of takes away the Fed's cover to predict Fed rate cuts next year. And of course, along with this, the economic data has remained strong. The other part of the dual mandate, besides just keeping inflation under check, is full employment, and our jobs continue to be added at a pretty strong clip each and every month. So those two things do paint the picture for the Fed to have to, again, stay firm. Right now, we'll say, what's important to us is how we're positioned and then how the markets are viewing probability of Fed cuts. And right now, the market is way off sides in terms of the Fed either not raising in November or even not cutting next year. So we're very in tune with the possibility that they surprise markets in that regard. So that's the Fed and the bond side of things. Andrew, pass it over to you. Talk about small caps.
All right, thanks, Adam. Yeah, so looking at the small cap market is not a market we've been able to talk a lot about this year. We've really been focused, as have pretty much the rest of the market, on large caps, the biggest stocks. We've spent many market carvers talking about the FANG names, the Facebooks, Amazon, Microsoft, all those big mega cap companies. And really, we haven't had the opportunity to talk a lot about the smaller name companies because they haven't had great performance. It's really been all about those mega caps. Now we're starting to, as we continue throughout the year, we're always looking for those opportunities. And right now we're starting to see a little bit improvement in the small cap space. Now, small cap stocks, they were hit much harder by the rising interest rates that Adam was just talking about. Smaller companies are much more sensitive to hiking rates. And so naturally, they did underperform and have had a more rough year in 2023. But now we're starting to see below the surface, we're starting to see a little bit better improvement. So something I often talk about in the market carver is looking at the breadth data, the participation of individual stocks. So as the S&P 600, the small cap index, as you're seeing on the chart on your screen, as it's been going lower, when we look under the hood at how the individual stocks are performing, we're actually seeing that the data is actually less bad. So you can see here's looking at the 1 month, the 3 month, and the 6 month percent of stocks making new lows over those time periods. And while the index has been going lower, less stocks have actually been making new lows, suggesting that maybe we're starting to see some stocks start to firm up. They're not showing the same level of weakness. In fact, looking back the last time the S&P 600 was at this current level, we were seeing a lot more stocks making new lows. For instance, 26% were making 6 month lows. Compare that to right now, we're at 14%. 39% were making 3-month lows. Now we're only at 23. So we're starting to see some good improvement. We're not having as many new lows under the hood of the individual stocks, and that's a positive sign for the index. This is the type of data we're looking for to suggest maybe we could start seeing small caps begin to improve and make adjustments as appropriate within the portfolios. And so we're looking for those opportunities now as we start seeing this internal data begin to firm up. Now shifting, looking from equity market, looking over to commodities. One commodity we do talk a lot about this year has been oil. Oil prices have been going all over the place. Oil supply, looking at SPR. There's been a lot of topics of conversation regarding the oil market. And we have another one to talk about today is U.S. oil production. So a lot of the focus has really been about what's going on in Saudi Arabia, how much oil is going to come from there, and all these different headlines. But now we can finally bring it back home and look at how much oil are we producing domestically. And in fact, we're encouraged to share that we're actually hitting a new all-time high. And that's what this chart I have today shows, looking at the total production of U.S. oil. And if you look on the far right, you can see we're just now breaking above that pre-pandemic high as we've really started to ramp up production here at home, coming out of that large decline that happened after kind of that COVID crash in 2020, 2021. We've slowly started to climb back higher. And as of the latest data we have, we are now producing more oil than we ever have in the U.S. history based off of this data set. So very encouraging. And this is something we hope we can continue to be maybe less reliant on foreign oil and continue to have that production, a lot of that revenue stay here at home. So we're very encouraged to see production continuing to climb higher from a commodity that we're continuing to heavily be reliant on.
Yeah, absolutely. And thank you, Andrew. And that's just continued, staying with what we had talked about in the thirdly and opening the door for energy exposure. And since then, just to give you a brief update, we have increased some energy exposure. And with this data point showing you we have high levels of production here at higher prices because of what's going on in the rest of the world, continues to set that up as an area of attractiveness. So thank you, as always, for giving us a few minutes of your time. As always, we'll give you a reminder to give us a call if we can be of service to you. 800-928-4001 is the phone number. Thanks again and have a great weekend.